Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
So we've got all three of us back today. That was kind of a weird couple sequence of weeks. We did like 100th show, and then it was like you and me, and then it was like you two guys, and now we're all back here. So thank you guys for covering while I was out of town. I appreciate it.
Yeah, you're traveling. How was Florida?
Yeah, Florida was cold. Like,
what?
It was legit cold. I heard you guys talking about it because like I was FaceTiming, and part of the footage I saw, I was like, hold on a second, that's not making it in the show. But it was 36 degrees. On the morning you called me, it was 36 degrees. And I'm like, what is this about?
Yeah, I know. I was like, damn, you should be having vacation, not a jacket vacation over there in Florida.
No, we were at a wedding. So
you definitely know Andy's back when there's numbers, graphs, and decimals.
There's not even did you say decimals? Not decimals? Wow, okay. Decimals. New word introduced on the show. There's not even a chart on the screen yet.
Jeez.
So guys, the general topic today is a really confusing start to 2025. Now, I don't want to like belabor the point because there are certain things that like they don't make sense. Yeah. So we're going to kind of talk about some of them today because, we've had a couple of confusing starts to years in the last several years, but this one honestly is baffling me for a couple of reasons, but I think that there's some answers we can give people here, even though I'm still left with a lot of questions. So I'm sorry if that's like too vague to start a show, but that's kind of just where we find ourselves. And I promise, Brian, there won't be a lot of charts and graphs. It'll be just enough. Does that sound good?
Oh, I like that.
Yeah. It'd be like the Three Bears.
Just enough.
Like,
too hot.
This show doesn't have enough charts. This show has too many. This show has just right.
You know what, Andy? I mean, you're bringing up a great point. It's not too vague. It's just everybody's understanding this market. It's just a crazy, vague market.
It's weird.
It's very.
I know that doesn't like describe it, but it's weird. So like, let's go right away with some of the weird. How about that? Pending home sales? Let's do pending home sales, guys.
All right.
Weird from pending home sales. They dropped to the lowest level on record in January 2025. Now, this is the lowest on record. They didn't start measuring this till 2001. So we're now in we're entering the 24th year of this like piece of data, and it's the lowest ever.
That's crazy.
Here we go, another record. Woo! But in like the wrong category. Here we go, guys. Setting records once again. Yeah. So pending sales dropped 4.6% from December to the lowest level since the National Association of Realtors began tracking this metric in 2001, with more sellers cutting prices, but nationally they're still higher than they were a year ago. So here we go with this whole, the price cuts are going to come. But it's like, okay, but values are still up. So is it just back to the value it was in 2024 or 24 and a half?
Slowly retracting back to what there was.
Yeah. So, I think that, they make the claim, weather's part of it. Yeah, weather might be part of it, but it's not that much part of it that I think there's going to be like this massive boomerang in the spring.
Nowadays you're just trying to blame whatever you can blame, right? I mean, at the same time, it has been one of the coldest in, some parts of our country here. And it has some effect to certain things that are going on, but not to this extreme, right? Like that's where I'm.
When I was reading this, I was thinking to myself, if I'm a listing agent, am I telling someone, hey, don't list your house, it's going to be cold next week? Like, okay, I'm not saying that to myself. So like, I understand in general the argument, but also like when people got to sell their house, they got to sell their house. Yeah. So I'm not sure I'm 100% on board with that. So obviously high mortgage rates or mortgage rates that remain elevated are contributing to this. But look, it feels like 1 week we talk about inventory and it's inventory is on its way back. It's surging back. And then we go, whoops, no, pending home sales, actually closed sales dropped to their lowest. Like what gives, guys?
Don't know. I wish I knew. I don't know.
It's a good question.
I'm confused. That's a good one. Are you asking me? No.
I'm asking because it's confusing, right?
No, it's very confusing, Andy. And I mean, a lot of this cause right now, the pending home sales, you got to remember, we're starting with the new president. I think all these things that is going on is just bringing a lot of uncertainty to the consumer. I mean, it's bringing me uncertainty as well, especially all the firings with the federal government, all that stuff. Like all this thing has an effect. It's going to kind of pause things. It's just going to let people really figure out, is this a need right now for me to go, or am I okay right now with renting? They got to try to figure that out and see where that happy medium is. So seeing that there's pending home sales have increased, for me right now with all the uncertainty that's going on out there, I don't see that this is very uncommon. I think we're going to see more of it as we move forward.
That they dropped.
Absolutely.
Yeah, and I feel like everything's just like unthawing. I feel people that were looking to get in the market and that maybe halted because of the layoffs and everything, they're probably saying, hey, well, what's going to happen if I'm a government contractor, government worker, is my job on the line? So if they're in the process of wanting to, step up in basis in their current situation, that's something that maybe is like, hey, well, I don't know what tomorrow's look like, so maybe I have to stay put for right now.
So I'm glad you guys mentioned that. It's something that crossed my mind, but it's not mentioned in the article, right? So they didn't say it. No. And I don't know if there's an angle on that or not. I'm just I'm just admitting, like, okay, I was kind of thinking the same thing. Like, there's a lot of uncertainty. People aren't sure. There are a lot of government jobs, and localized out here in San Diego. There's a lot of government and Fed stuff happens here too. Obviously, more concentrated in DC.
I was just going to bring that up. I'm going to look at DC as soon as the word came out.
But again, like this whole uncertainty and not knowing, I can understand why some people would not list, and then that, or even if they did list, there's just less people. But again, like we've talked about this a couple shows ago, it's like inventory is up, like way up from 2024. So even the fact that it's up, but then the pending sales, then there's ghost inventory somewhere, or it's just coming off the market. I didn't pull the stat of how many expirations there were, because expired listings, that might be interesting to look at and go, well, how many have expired and just haven't hit the market again? There's probably a big number in that, because obviously they're going somewhere.
Yeah. All I do know is our inventory is increasing. I want to say this week we left off at 642,000. No, I'm sorry, 639,000. A couple of weeks ago, we're at 632. So we've been seeing an uptick.
Right.
And this is like the 16th week that we've been seeing, a good uptick in home listings,
which should translate into pending home sales, but like they're not. So then I'm wondering, okay, then maybe they're just expiring and not coming back on, or something.
I said 16 week, it was 16 month.
16 consecutive months. Yeah. Which again highlights the trench that it was in back in 2023. Yeah. So the end of 2023 was like terrible. And then, that number 100% reflects that. So I'm hoping, this is kind of like my silver lining comment, is I'm hoping that this is like the end of that, and that we won't have yet another new record drop in February. But I mean, this being kind of, again, still that same level of uncertainty, I kind of have my hopes up that it won't be, but I'm also like, I kind of have like one eye open, like maybe it's going to be even worse. I'm just not sure.
Yeah. A positive meter for Andy?
Yeah, a positive meter. Yeah, I know. I feel sometimes like I'm just complaining about things too much, but also I feel like I'm also pulling some articles where I'm like, well, what do we do about this? Because it's hard to make sense of this, because outside of people's aspirations to buy or sell for whatever their personal reasons are, it's hard to economically say people should do that, because we also see with equity so high, it's the thing that's saving people from their own personal debt right now in a lot of cases. It's kind of their backstop. Thank you.
Need to refinance. You have a ton of equity.
Well, right, and if you
that's the thing that everybody's going through right now.
If you can do it, right? If because you have the equity, but can you afford what you're doing?
Of course.
And is your credit still high enough that you can qualify?
And at the end, I mean, it goes to worst comes to worst, I can always sell.
You can still sell. Well, and we're going to get in that because actually, I'm super surprised the foreclosure numbers are so small.
Yeah.
Yeah, and there's an interesting stat at the very end of that I'm going to talk to you about that I noticed that they didn't highlight, and I did some math, and I'm like, oh, shoot, that actually is crazy.
Well, it's crazy. I mean, that just signals strong economy, strong job market.
It does, but does it? I think it's a lock-in effect that we talked about.
Okay.
I think there's that too. Because overall, average home price or home cost per household is still low. New acquisitions are really high. Yeah. But people who refinance in 2020, 21, and 22, their mortgage payments are like ridiculously low because the rate's super low.
They're locked in.
All right, let's move on because we're going to get to these other things pretty quickly. So home prices are finally cooling. Nearly 17% of sellers are slashing prices as more homes linger in the market. Hold on real quick. 17% does not equate to slashing for me, because typically we see 30 to 35% of listings have a home price reduction. So when they talk about a home price reduction, they don't use the word slash. Number one. Number two, they don't use the word slash synonymous with 17%. So this is just a little bit more than half of what is normal, but they're saying slashing prices. So a little bit of hair on fire title here from Realtor.com. Thank you.
Play on words.
Thank you, Realtor.com. The standout for me, guys, was 45 of the nation's 50 largest metros saw the number of homes with price cuts increase since February 2024. Not really surprised, but again, it's kind of par for the course for me.
Yeah. And you're going to see it during these times. It is a cooling down. People are just getting done with, some people are still actually even opening Christmas presents, So some people are just kind of like, hey, let me open this thing. Let me just pay off some of that debt. So I think right now during these times, historically, we've seen that these are the slower times. We'll start seeing an uptick like in the real estate market. Mid-March is the tendency.
So you're saying those Christmas presents are soon to be St. Patrick's Day gifts.
That's it. the re-gift.
Rewrap it in green paper. Yeah. Oh, it's in green paper for Christmas.
And I feel like in addition to what Will was saying is that, I feel the demand is there, but people are now more, not desperate to go into a house because they do see, like you mentioned, more inventory coming out every week. More houses are coming out, and that gives them the positivity that they could be like, hey, well, I don't have to necessarily, feel like I have to buy right now. Let's get into the market, take it time by time. Yes, we want to buy, but we're also not desperate to jump into something.
We actually are seeing most of our buyers, they're presenting other offers. They're not just, before it would just be hyper focused on that one property. Now they're saying like, let me just put up multiple offers, see which one's going to be more attractive, to the seller, and which one I'm going to get accepted in. And a lot of times we're going to just see that they cancel those escrows just to get into the other one. Or a lot of times they get in there, let me see what I can still gain as far as repairs from the seller.
Yeah,
and if certain things don't get repaired, they're like, well, wait a minute, I have another option over here. And that's what we're seeing a lot of. And that's due to there being a rise in inventory. As a matter of fact, I did the research here in San Diego, and we've increased between 20 to 22% of more inventory. That's a good thing for a buyer right now.
Yeah, I feel like buyers are now getting a lot more creative, a lot more smarter with the way they're presenting their offers, because of the fact that they know there's multiple properties coming out, so they're going to have a lot more opportunities to get the offer that benefits them the most. And I think, before putting all your eggs in one basket, there wasn't that much inventory, so it's like, I really want this one. There's not much else to choose from, so I have to put all my eggs in one basket and I hope to get to
Yeah, no, absolutely. And I mean, it's right now it's advantageous for the buyer to actually even request for seller concessions, for closing costs to be paid. We're starting to see more 2-1, 3-1 buy downs. We just got an offer accepted with $34,000 in credits.
That's amazing.
It's pretty crazy.
That's
right?
crazy. That's a lot of money.
That's just telling you that the seller's willing, like, I got to move. I got to do what I got to do.
Yeah.
That just it blows my mind, because if they're giving out $34,000, what are they still profiting on that to be able to be like, I could give $34K? That's cool.
Yeah. Well, you got to remember, a lot of these people purchased, most of them 2017, 18, 20, and we saw a huge uptick from the pandemic to 2025. In some areas, we saw a 44-50% increase in equity. Yeah. So that's quite a bit, especially when at that point in time, I want to say the median sales price of a home was in the 7 and change. Do another 30-40% on that. That's quite a bit of equity built.
And I think, and again, this comes down to that whole like personal thing we talk about all the time. It's like some people's situations are different, their times are different, their needs are different. And so when push comes to shove, and not only literally, but like sometimes when it comes down to making the deal or not, you're going to make it or not. And it's just as simple as that. Sometimes the speed and the timing is it, and sometimes it's the numbers. I am going to flash a couple quick graphs up here, guys, only for the example of looking at the trends and how they're similar. There's nothing outlier in these last 5, 6, 7 years of data that they're using here for price reduction share, or even the next one, which talks about the days on market. It's all within trend. So we're not seeing anything, even with the pandemic, even coming out of that, even with the change of administration. You still see things mostly going in the same direction they would be in the seasonality of the month-by-month tracking that you see here. So to me, it is kind of like it's par for the course. Yeah. Even though I'm saying at the offset of the show, like, oh, this is a totally weird market. It's like it is, but it isn't. It's weird in that so many things have changed that I think these would have looked dramatically different, but they don't. Yeah. So the fact that they're the same is actually the outlier observation for me.
I feel that like towards the end of the year, how the market slows down, and the people that put their houses up at the end of the year and then go into their house not in contract into the new year, now they're like, yo, it's maybe a month, 2 months, maybe even that 90-day mark where they're like, yo, I got to get rid of this property. I thought I was going to get done with it, months back, weeks back, and now it makes sense why they're bringing down prices, because they have to move their inventory, they have to get rid of the property and make it enticing for the buyers to
and still, the market time, what they're saying here, 62 days, 11 days longer than the previous year. That's still not too bad.
It is.
It's not bad. That's not much of a statistical outlier. And what's I'm glad you brought that up, because I made a note for a year, is that one of the 4 regions actually had the time on market below the pre-pandemic level, faster.
That's crazy. Yeah.
Right. So it's like, wait a minute, that was already like a breakneck pace during that time. And then there's 4 regions that are even reporting faster. That's a lot of demand in that area, which means that on the buyer side, there's still people trying to hustle down homes.
Yeah.
Okay, great.
Moving on.
Yeah, moving on, guys. So we're going to quickly go to the next thing here. Insurance worries are forcing homeowners to rethink their living arrangements from Housing Wire. We already know this, but I think it's important to revisit this occasionally. We've talked about insurance a lot because of the insurance problems in 2024 that really reared their ugly head. Then we talked about insurance most recently because of LA fires, and then the fires that were in our own county here in San Diego. Also, our clients that have had policies non-renewed or canceled, whichever way you prefer to say it. The thing now, though, is that the newer conversation is this one, is that people are willing to modify or change their living situation because of insurance.
Yeah.
It used to be, no, I want the place so bad that I'll deal with whatever the insurance has to look like. And now it's like, well, what's the insurance look like? And then I may or may not even do something based on
I'm
that.
glad that you bring that point up. We just got an offer accepted in Florida, and it's for a $750,000 purchase. And we're in escrow. Everything's good. They gave us I want to say, was it a $15,000 or $20,000 seller concession? Not too sure. Anyhow, when the insurance came back from USAA, it was $833 a month.
What?
$833 a month. That caused our deal to just get
That's
out.
$10,000 a year on a premium.
That was we had to go and we have to rethink what we're doing here.
Whoa.
Yeah, that was
just doesn't even make sense.
It just the math didn't math.
Oh my gosh.
Yeah.
Well, okay. So I had a conversation with a family member earlier this week where we were talking about, what would it look like to qualify? And this is out in Nevada. And one of the comments I just happened to make without thinking about it. So this is how locked in this is in my own brain. And again, I don't do sales here, guys. So I just was kind of talking to a family member. My answer was this. What you qualified for before is not the same as what you qualify now, specifically because your insurance premium. You have to give that as equal weight as you would your mortgage, because we already know the total payment is going to be the DTI ratio and all that. But I said you have to get the insurance information as quickly as possible.
Yeah.
That's going to dent, whether you have HOA or don't have HOA, it's going to dent your qualification right away because it's way higher than it was when you last bought. So
true.
I'm even saying that, and I don't even do sales.
Yeah.
So what else are you guys telling people when it comes to this? Because, the behavior is now becoming a part of the subset of the factoring of whether people do, where they buy or where they don't. 57% of respondents said they would strongly consider moving altogether to avoid high insurance premiums and property taxes. This includes 43% who are planning a move in the next 5 years. 2 shows ago, we were talking about people looking to sell in the next 3 to 5 years, and it was the majority of homeowners.
Yeah.
So of this new set of data, 43% were planning to move in the next 5 years, and another 14% plan to relocate immediately to avoid financial strain. Which then downstream that creates new listings, which should create new pending home sales, which, right? So, what do you think this is gonna? Do you think it's gonna unfold the way these numbers are suggesting, or do you think this is just, I can answer this way, but I can do something different actually in real life?
Well, first off, I wish that you could just pay it outright and it gets removed from your DTI if you paid it yearly. Like, it just makes so much more sense. Like, hey, I don't have to pay it, so therefore it's already paid for. Take it off my DTI. But unfortunately, what happens is that you have to go back to the drawing board, because if A, it doesn't match with their budget, and then B, it doesn't yield them the approval, and now they're over the approval DTI, then what can you do? The insurance isn't going to say, hey, we'll make an exception and drop the premium.
Yeah.
They're not. So you're going to have to go back to the drawing board and reassess your situation and say, hey, is this house for me right now? Do I want it? A, I can't afford it on paper, but at the same time, is the money that I'm paying towards this even worth it? And, and your end goal, if that doesn't align with everything, then I think it's kind of like, you're going to have to digress and then restructure your plan.
Yeah. I mean, the good thing about it is when you enter an escrow, you have your due diligence, right? Get your appraisal done, do your home inspection, make sure that you're shopping for the insurance. Because at that point in time, you have a certain window of time where you can go out there and just make sure that you're going to get the proper insurance. And that's a lot of times where they do get these insurance policies, and they see that, well, this is too much. I'm going to have to rethink of where I'm going to actually look. So maybe looking in, rural areas may not be the thing. I'm going to have to now go to more suburb or more urban, right? So those are the things that I think people are going to have to just change their minds and not just set them. This is where it's going to be at.
Yeah, and especially I feel now with the whole, fires that we just went through in our backyard in LA, like, do we expect insurance policies to go lower?
No, you don't.
Unfortunately,
I think, unfortunately, I believe that some of these numbers are predictive, and they're predictive. Okay, it's people responding saying, yes, I'm going to have to make a financial choice because of insurance now, that maybe insurance was an afterthought or kind of a sidecar attachment to the main thing. But now it's like the prominent thing. There's like the mortgage payment and insurance. Like, the insurance is a big part because it's going to dent your approval amount. But then I think this is actually kind of just the beginning, because as it actually becomes real for people and they actually get their premium amount in the mail and then it becomes real for them, I think even more people, when asked this question, let's say 3 months down the road, 6 months down the road, I think that this number is only going to grow, and the insurance problem is actually going to cause some more migration. And I'm not just talking about the areas where the people's homes were burned down, unfortunately, and they won't be rebuilt for 5 to 10 years or whatever the timeline is. Yeah. I'm talking about people who, they live in a place now, and they're like, I'm either not going to get renewed, I'm going to have to move, or I'm going to get renewed and I can't afford it.
Or they're just not going to renew.
Well, right. Or just take no insurance at all, which, again, now that has its own inherent risk, right? So I think that the numbers we're seeing now, although they're kind of big numbers, I think they're actually just the starting point, not the ending point for what we're going to see to come in 2025.
I agree. Yeah, I agree.
Yeah, and I don't say that from a level of pessimism. I just the conversation is happening.
No, of course. These are the realities that we're facing right now.
And if the premium increases are approved and they prevail, then they're gonna show up in the mailbox or your inbox, and you're gonna go, whoa, hold on, my premium's now 100%, 200% higher than it was. Yeah. Now you're gonna have to really be faced with it and then make a choice, and that's gonna totally shift behavior.
It's still hypothetical right now.
Yeah, I mean, it is. It's like it is, and it's coming. Yeah. Right. So I don't know if this is going to result in inventory in 30, 60, or 90 days, or like in a year. But like people's budget and then also their tolerance are really going to become tested.
Absolutely.
100%. Yeah. I unfortunately think people are going to cancel, like you're saying. But again, if you still have a mortgage and you're canceling,
oh yeah,
you can't.
Yeah, you get forced insurance.
You're gonna So there's some other legal problems you're gonna have if you do that. So please don't do that.
Yeah, no. Keep insurance.
Keep your insurance. Yes,
by all means, always be insured, no matter what. The good thing is there's still providers out there. There are still people. We get people in escrow. I ask them before. We used to just be really quick and refer them out to a couple. Refer partners. I don't want to say they're partners in any way. But in a monetary way.
Trusted insurance agents that we know.
Exactly. So we'd send them there, but now I just tell them, you got to search first. Go to whoever insures your vehicle. That's one, because usually you have a bundle together already there. Yeah. Or, just go to your current homeowner's insurance who you already have.
You can even ask your realtor. You can even ask other people in that neighborhood. Go knock a door or two. I know that sounds probably a little aggressive. I mean, but ask.
It's pretty easy, right? You can go ahead and just go on your Instagram. A lot of your friends are homeowners. Just ask them.
Yeah.
And then I kind of utilize ourselves as that second option. Like, okay, here you go. We're going to send the information, but we're going to connect you guys directly.
Yeah.
No affiliation, no nothing like that. And the good thing is we've been seeing some positive news out there. We've been seeing coverages and that they're not that strenuous.
Yeah, it's not that insurance is going to end. It's that your options are less than they used to be. Yeah. And you have like the biggest carriers who are like, peace, I'm out. I'm leaving the state of California. Like, that's a big deal. I get that. Yeah. I'm not trying to undermine or undercut how severe this is for some people. Yeah. But your point is absolutely nail on the head. Is there's still insurance carriers, and a lot of them are going to double up and do whatever they can do, and then still fall back on the California Fair Plan for those of you in California. And if you live in another state, that your options are going to be different than they might be here in California. So just don't close the door on your insurance, please. Keep your house insured.
And then, you earlier you're saying because of the fires and all that, just imagine in Florida. I'm sure they don't have fires, but they have the,
hurricanes, you got flooding. I mean, there's also,
$833.
Different subset of issues.
Yeah, it's just crazy. And this is not a thing that's just happening here in California. It's happening nationwide.
Yeah, I think there's going to be some sort of insurance. I was going to say rebrand. I don't mean rebrand. I think they're going to have to rethink insurance this year and next year, because there's also going to be federal pressure. Like there's going to be federal pressure that comes down on these insurers and say, you have to do something. I mean, it's like the state of California. I'm going to try to cite it. I don't remember what the rule was, but they signed some clause just recently that said you cannot cancel people for X amount of time if they're currently insured, and then you have to give them an option or something like that. So I'm sorry I'm blanking on what it was, but I just saw it like a week or two ago. So they're actively trying to work on the government side with the insurance carriers to just make sure everything is okay for now. Okay, guys, last article today. We got to talk about CoreLogic because it's already been, 2 months of the whole year. I have not brought any CoreLogic to you. So now here it comes, okay? I give you a break. It's not every month.
Thank you so much.
It's not every month.
I was itching. I don't know about you. I needed some numbers.
It's not going to be every month. It's not going to be every month. It's going to be once a quarter, okay, guys? We're going to do a CoreLogic once a quarter. This one is definitely nerdy, but I want to talk about this specifically in the mortgage sense because it's the loan performance insights. This is foreclosures. Foreclosures, there's only 3.1% foreclosure rate, which is 97% of people making their payments on time. And I'm going to draw a direct correlation to our unemployment number, which is 4% currently. So you have foreclosures less than unemployment, which I think is honestly a very good sign.
Yeah, it is a very good sign. Very good.
But is it?
It is because, and here's why. And I'm going to put this chart up on the screen. And what you're seeing up on your screen is the 30 days or more delinquent national. And this is the 3.1% of homes are 30 days or more past due. And as you see in the progression, you get to 30 to 59 days, 60 to 89. It's fewer and fewer and fewer. What's super interesting is you just jump to the 120 days plus.
That's what I circled too.
See how it says 0.7?
Nothing.
And then you have in foreclosure 0.3 or 0.2. This is people getting out of that somehow, very last minute.
Yeah.
So my point I made a couple minutes ago was like, hey, I got something to show you guys on the graph. I was like, wait a minute. They didn't overtly point this out, but look at the dark number there. You see 0.7 to 0.2.
Just kidding. Where's my foreclosures
That's
at?
only a third. So of the people in the 120 days past due, only a third of them are actually going into foreclosure.
Yeah.
So where are all the foreclosures? We said we're coming, and we heard we're coming. Where are all those people now?
Yeah.
Where do you think they are, guys? I have no clue.
After the pandemic, though, we had government assistance where people were getting loan modifications. The government was asking them not to pay payments, or they were getting payments paid by the government. It was like 550 some million homeowners, you know. So I think they're going to start coming now with this new administration. All that stuff, the umbilical cord is just going to be cut. And I think that's when we'll start seeing a lot more of
free market,
you know, of these foreclosures.
So on the 120-day time frame, so what is that, 4 months? So do you think that, like, let's say in 4 months from now, it'll be higher than 0.7 in your estimate?
Yes.
Yeah? More like maybe 0.9 or 1.1.
I won't say exact, but I think it's going to be an uptick for sure.
So possibly some more spillover from this 3.1 kind of cascading into the 30 days, the 60, the 90. Okay.
Yeah.
I think if there's more layoffs and people lose their jobs, I could see that number going up as well.
Yeah.
Okay. Yeah. All right. Now, again, to your point you made earlier, though, well, if you have equity in your house, you could just sell it, thus avoiding foreclosure. So I think tucked inside this number somewhere is some of that inventory where people are selling, which is maybe where some of the inventory is coming, which is odd, though, because if it is that inventory, then why isn't it showing up in the pending home sales report, right? So there's some gap there. There's something still falling out of the net where it's coming through the funnel, and it's something's falling out somewhere. I don't exactly know where it is, but I also wanted to bring up one other quick thing, which is the select states graph, where their overall delinquency rate in December 2024 was significantly higher than the national average, but hadn't changed from the previous year, which is interesting because you see Louisiana, Mississippi, West Virginia, Florida, Alabama, and Georgia all well above the average. But then you look at the next next column over, their annual change had their change like not at all or barely anything at all. Yeah. So they're pretty much par for the course and very consistent despite being higher than the national average. I think that's economics, Scott. I think it's got economics written all over it. How about you guys?
Of course.
All right. So one more thing is home prices keep climbing in the U.S. Many homeowners continue to acquire equity, which can be used to help borrowers pay their bills in times of need. How many times have we been talking about this? How many examples do we have? How many people you have calling, emailing, texting you, yo, I'm in trouble. I need to get some money out of my house. I need to consolidate my debt. I need a home line of credit. Like, this is what we've been saying since like the summer of 2024, maybe even the spring of 24.
Yeah.
And hey, CoreLogic is now saying it. So I'm going to take a victory lap. They're confirming what we've been assuming.
Yeah. Well, the confirmation is there with what the actions that we've been performing. You know, for example, I'm doing a cash out right now for $200,000, and $70,000 of that, the clients, they took my advice 8 months ago, and they already got their permit. So they utilized their savings to go get the architect work on one of their properties, which is a garage conversion. And they already got the permits for that. They already got the subcontractors going to go in there and they're going to do the work. It's going to cost them like $70,000. All permits have been paid, and so now they're going to break ground as soon as I give them their money.
Wow.
You know, and then the rental, because they're here around the corner, they're going to rent that 1 bedroom, 1 bath for $2,200.
Ooh.
So what's cool about that is their mortgage. I did the math. And once we broke everything down to the client, it seemed like, whoa, it's $200,000. I don't need that much, Will. I only need like a few to pay that. But once we put everything on paper and I gave them that rate, at that time, it was a 7.6. Right? Now it's gone down to like a 6.875. Wow. So now they're going to be they were paying $3,600 currently. So their payment, I want to say, went to like $56. But now if you're renting for $2,200,
there's your
covers. Yeah, well, because on the surface, on its face value, someone says $200,000, like, whoa, that's a lot of money, right?
And Andy, I'm sorry, but that's to cover the debt and the ADU. Remember,
right.
70,000 of that 200, so they paid off debt already of 130.
That's what I'm saying. That's crazy.
You know what I mean? So because of the rental income they're going to receive from that, it offsets.
Well, right, because they're canceling out all that out-of-pocket expense connected to that debt, but also then creating a cash flow in stream too. So I'm actually I'm really curious later to see what that net change is per month.
Yeah,
because I understand. I hear you saying the gross change
Yeah.
is more, but their net change is going to be substantial.
Oh, of course.
Yeah,
Of course,
and,
of course.
And I know there's also people, oh, you should never do that. That's fine. You don't have to do that. If you're in the comments, you're like, hey, no one should ever do that. That's fine. We're not telling you need to do it. He's saying someone is doing it, and he's telling us why.
Yeah, no, and it's a different. Everybody has a different appetite. This is how we figured out, because they're older. So it's like, how do we position them in the best position possible, utilizing their current investment? And this was the best solution. When you put it on paper, it's like, whoa, that makes perfect sense.
Well, how else are they going to pay $130,000 of personal debt off?
Exactly.
No, I mean, unless you have that money or you're generating that money, you're just going to be like dripping to pay it down, which is going to take forever or not at all. So back to your point earlier, like people that have equity can sell their house, they can refinance it, pay it off, or do that and then also do the garage conversion and create an income.
But here's the other thing. A lot of people don't want to make that sacrifice. They don't want to lose that storage space, right? And it's like, realistically, you're just storing a vehicle or Christmas stuff. Like, the whole idea is just get out of that mindset and leverage the garage so that you can utilize income out of that.
And to most people, it does not sound traditional. That's not traditional ownership. But again, like we've talked about how the idea of traditional ownership has changed dramatically, even just in the last 5 years. Not just generation by generation, but I think it's that, and also because of what housing has looked like in the last couple of years, it's completely shifting the behavior.
Absolutely.
It goes back to just, leading with your emotions, and it's like emotionally living rather than, practical living, and being able to pay your cost of living down, while at the same time being able to put more money back in your pocket. But a lot of people look at it like, well, this is my house where I'm going to live at, not a business that I could run at. It's not, I don't want to do that. It's too much. But at the same time, they're putting themselves in a better situation down the line, but at a sacrifice right now.
Absolutely.
Yeah.
Can't wait to see the after.
Well, no, I have no more graphs for you guys because I don't want to show you the last one because you're just going to make fun of me. So I won't. I'll spare you the last one. It. But I'm going to. Okay, fine. I'll show it. Here it is. All right. So this is actually the metropolitan area map that shows, because if you look at the state, the assumption looks, oh man, that state has it really tough. But when you look at the municipality map, it's actually pockets that are driving the result for the state, not the entire state of its own. So it's spread out here. You see how it's kind of speckled, if you will, for lack of a better term. So for those of you who are listening, you have this map of the United States, and it's got each of the states, and then it's got these county boundary lines, and it's speckled with these different colors that are showing the density of foreclosure and delinquencies. And what my point is here is that the entire state is colored one way or another, but it's really by the pockets that are generating it. It's not every county that's having the same problem. It's not every part of the state, and it certainly is not every state at large. So there you go.
Boom, boom, boom.
Make more of that if you will. Otherwise, that's it from Professor X today regarding that.
That's awesome.
So
thank you. Brian,
what was your favorite part of today's quick show?
Today, my favorite part was the home prices being slashed. The way that they articulated it and put it in there was very sly. But we know what's going on here, guys. We know what's going on. So that was pretty interesting.
17% equals slashed.
Oh, wow, crazy.
33% equals price reduced.
Yeah. Like, you see the connotations in them, like slash is like, yo, whoa.
Yeah.
And then reduction is just like,
Yeah.
So that was good play on words.
How about you, Memo?
Mine was the last article, the loan performance.
What?
Yeah, it was. One, I get to see the data. Core logic, you don't fail us. No, I like I like it that, our unemployment rate, this is not superseding that. And it's just telling me that, when I've been in the mortgage meltdown, I saw a lot of foreclosures. I saw a lot of families being ruined. I saw a lot of divorces. There was a lot of that stuff going on. I really think something that showed us in the pandemic is that the loan modifications are real. The government's not there or banks are not there to kick out people. They're really trying to figure out, how do we find the best solution for people? I know there's a lot of people right now that are going through stressful situations financially. And so seeing that our foreclosure rate is so low makes me feel at ease because they have a home to go to. They have something where they can still raise their kids. They have other ways and means of how to, modify their situation with their current bank. So it just gives me that relief that things are working out.
I'm going to double up with you today. It's a part A and part B for me. It is CoreLogic, not because it's CoreLogic, because of what it is talking about, what it represents. The amount of equity that people have in general these days gives them 2 outs of any tough spot they might find themselves in financially. Number one, if you have the equity and you can qualify to do some sort of cash out or a home equity line of credit to pay off your personal debt, reduce your total monthly outflow, look to the house to help you out. It's okay that if you're in that situation, it's okay for you to tap into the home and figure out a way out for yourself. And also, I'm going to say change your spending behavior so you don't find yourself there again. And if that still does not work for you, you can still sell the house and get yourself rid of those, let's say, financial problems that are ailing you and let the house do some work for you. It is okay this day and age for you to let the house do some work on your behalf. Please do not feel embarrassed or ashamed by any of that. Ask for help, raise your hand, tell us what you need, and we'll guide you along the way.
You know, I like that, Andy. I like to add that. Thank goodness we see these equities that have gone up. A lot of times we go into a home where people don't see any of this equity, you know, and so you're making these payments, but you don't see your property grow with that. So if you're in a position where you do have that equity, pat yourself on the back, and thank goodness that you have that, and now you have an option to do something about it, you know. So a lot of times we're just so stressed out that we don't realize the solution's right there, right underneath our nose.
Yep. And it may just not be the favorable one, but it might be the only one you have. And so you can get yourself out of that position. And I'm going to meet you right where you're at. When's the last time you've seen an article on any major news, economic, or business site that's talking about short sales?
There isn't.
There might be here and there, but guess what? It's not that big of a deal that anyone's talking about it at large because of the equity thing.
And they're happening. They are, but it's not out there.
There's always going to be a short sale somewhere, but I'm saying it's not at the rate and prevalence that it's worth talking about at a national level yet, or now. I shouldn't say yet. I'm not trying to say that's going to happen, but I mean, look, you might hear about it here and there, but it's on a case-by-case basis. It's really not happening for most people.
Yeah, and you know, here's the thing: what a lot of homeowners don't understand is all that's negotiable. You can go back to your bank, the servicer, and try to figure out what you can negotiate with them. You know, based on your income, they'll work with you. Yeah. I've seen clients, they extended their term to 40 years.
Yeah, that's great. Yeah,
you know, so
never
give up.
Never
give up. Exactly.
Yeah,
that's awesome.
The bank's not in the business of holding houses. They want to make sure they get money.
If they wanted to sell houses, they'd be in real estate.
Yeah,
they're not. They're into lending money.
Yeah,
right.
Yeah.
And that's a good point because they have to hire an attorney.
Yeah, it's more work for them, and they're not in that business. So it's like it's more tedious and more work for them to go and put the house off for sure. So when they could just say, "Hey, I know you need the house. Yeah. We like where we're at. We want to keep doing business with you. How do we all just solve this?"
Yeah. Awesome.
Yeah.
Oh, I appreciate you guys. Thank you so much for having me back on the show.
Welcome back.
I'll say. Yeah, I appreciate it. And thank you all for watching. Remember to hit that like button, subscribe to the channel, and turn on notifications so that every time we drop a new video, you hear about it first. We have more coming up with Will and Brian in our case studies and success in the market series. That'll be coming in the month of March. So you're joining us at a great time of the year, the upswing into the spring season, and with some actual case studies that you can lean on for your own experience and to get yourself out of maybe some trouble if you find yourself in them here and there. So you guys, thank you so much for a great show this week.
You too, Andy. Welcome back.
Yep. Thank you all for watching, and we'll see you all again next week.
See ya.
So if you enjoyed this video and got value from it, subscribe right here. And if you want to watch another video, click right here.